Ever wondered how to invest in value stocks? Let's dive into this fascinating world of finance. Value stocks, as the name suggests, are stocks that are considered undervalued relative to their intrinsic worth. They're like hidden gems in the stock market, waiting to be discovered. These stocks have a lower price compared to their intrinsic worth, which is based on the fundamental metrics of the company, such as earnings, dividends, book value, or cash flow. The beauty of value stocks lies in their potential for capital appreciation. Think of it like this. You're at a yard sale and you find a vintage item priced way lower than its actual value. That's exactly what value stocks are. They are shares from companies that are undervalued but have the potential to shine once the market recognizes their true worth. Remember, value stocks can be a great way to invest if you know what you're looking for. How does one identify and invest in value stocks? Well, the journey begins with a keen eye for companies whose stock prices are lower than their intrinsic value. This is where fundamental analysis steps in, a powerful tool to assess a company's financial health, growth prospects, and valuation metrics. It's like being a detective delving into earnings, cash flow, book value, and dividend yield. But remember, this is not a treasure hunt for quick riches. It's a game of patience and discipline. You're not just looking for stocks trading at a discount, but those with potential for real, long-term growth. So, you found a stock you believe is undervalued. What next? Well, it's time to play the waiting game. Value investing is all about watching those undervalued companies and patiently waiting for their market value to rise. Remember, investing in value stocks is not about quick profits, but about finding undervalued companies and patiently waiting for their market value to rise. Like any investment, value stocks come with their own set of pros and cons. Let's dive in, shall we? On the bright side, value stocks offer the potential for capital appreciation. If the market catches up to the stock's true value, its price might just shoot up. Plus, many value stocks provide a steady stream of income through dividends. And if you're not a fan of roller coaster rides, value stocks might be your cup of tea, as they often have lower downside risk due to their discounted prices. But it's not all sunshine and rainbows. Yes, value stocks can be like hidden treasure, but sometimes they turn out to be traps. Some stocks may remain undervalued for a long time, or worse, never reach their true value. Also, value stocks might not offer the rapid growth that some investors crave. Lastly, timing the market is a tricky business, and identifying undervalued stocks is no exception. Weighing these pros and cons can help you decide if value investing is the right strategy for you. Did you know that some of the most successful investors in the world are value investors? That's right. Gurus like Warren Buffett, Benjamin Graham, and Seth Klarman have all mastered the art of value investing. Take Warren Buffett, for instance, often hailed as the Oracle of Omaha. Buffett's strategy revolves around buying shares in businesses for less than their worth, and then holding those shares until the market realizes the real value. Then there's Benjamin Graham, the father of value investing. He believed in thorough analysis, preferring to scrutinize the financial stability of a company and its future prospects before making an investment. Last but not least, Seth Klarman, a less well-known but equally successful value investor, emphasized the importance of a margin of safety, ensuring a buffer against errors or downturns in the market. These investment gurus have shown that patience and discipline can lead to significant returns in value investing. So how do you calculate the value of a stock? Well, several methods can help you pin down a stock's value. One popular method is the discounted cash flow model, or DCF. This model estimates the present value of a company's future cash flows. It's like peering into a financial crystal ball, projecting future cash flows, and then discounting them back to today's value. Then there's the margin of safety principle, which involves buying stocks at a significant discount to their intrinsic value. Think of it as a safety net against potential downside risk. The price-to-earnings, or PE ratio, compares a company's current stock price to its earnings per share, while the price-to-book, or PB ratio, contrasts the current market price with the book value per share. Another method is the dividend discount model, which estimates the value of a stock based on its expected future dividends. Lastly, the earnings yield flips the PE ratio to calculate the return on investment based on earnings. By using these methods, you can determine if a stock is undervalued and potentially a good value investment. Leverage on bullbearvector.com to find the right stocks and options to invest, helping you to save time and reduce costly mistakes today.